Good morning. Well, our walk and talk today has brought us to the library. It is very windy outside, and our audio would not have come through for you, so we're doing this a little bit different today. I have Tyler here with me. He is from CMG Financial, and we're going to be talking a little bit about mortgage options and mortgage options beyond your traditional 30-year note. And again, I'm Sophia Keeler. Thank you for joining us today. Remember, if you are enjoying these videos, go and click that subscribe button. So just to get into things real quick, Davy, tell us a little bit about who you are and who you work with.
Let's see, my name's Tyler. I work for CMG Home Loans. We are nationwide, but we do have our office location here in downtown Corpus. We are actually located in the American Bank building. But yeah, I've been doing mortgages. Actually, I think I started shortly after Hurricane Harvey. So
Okay.
That's when I started doing mortgages. But I've been doing mortgages ever since then, and I love it. It's a great industry. So.
Awesome. Great. Well, I know that Davy has a lot of options available when it comes to mortgages, which is why I wanted him to come and talk with you guys today. Of course, you guys do your traditional Fannie Freddie loans, 30-year notes, that pretty much any other mortgage company is also going to provide. But I also know that you have some other options available. Just real quick, can you give a quick list of some of the other products and what they're called, and then we'll get into a little bit more of the details.
Okay. Yes, so we do offer, all your traditional products, just like everybody else, but everybody's situation is different. So not everybody fits within the box, basically. So, depending on your specific income scenarios or credit scenarios, stuff like that, we have different products to cover those particular scenarios. So, for instance, we've got bank statement loan. Due to the way you claim your income, maybe a bank statement loan will work better because then we go off of the deposits instead.
So is that something that might be a little bit more beneficial to someone that is self-employed as opposed to working for a company?
Exactly. So, because whenever you're doing your taxes and stuff, everybody's always trying to figure out ways to kind of write off that income, but that ends up showing less qualifying income.
Yes.
So those bank statement loans are a route to take, as well as let's say if you're doing purchasing investment properties, there are DSCR loans that basically go off of the income that you'll be making off of those investment properties.
So that goes off anticipated income.
Exactly.
So if you have a property that you're purchasing, maybe you're going to do a little bit of work on it and turn it into a rental property that you're holding on to. Are you able to offer a loan on that if there's not currently a renter in place off of the anticipated income once you put a renter in place?
Those ones will have, we got to kind of dig into it a little bit more, and a lot of times they want to see let's say you're purchasing a rental property that already has renters in it. Mm-hmm. That would work better in that kind of situation. Okay. So that way you already know that that income's going to be coming in from that rental property.
Okay.
There's all sorts of different loan types. There's also one that we like is it's an all-in-one. It's basically like a home equity line of credit.
Okay.
And that one's really nice because it's a completely different way to look at mortgages. We are taught to look at mortgages a certain way to where we are looking at that 30-year fixed mortgage. And if you're looking at that 30-year fixed mortgage, we know the way they amortize that. In the beginning, you were paying majority interest. Yeah. And then as the loan progresses, then you're slowly starting to pay on that principal balance.
Okay.
So you end up paying quite a bit.
So what property is that home equity line of credit on? Is that on the property that you're purchasing, or you're using an existing property that you already have equity on in order to get the funds that you need to purchase the next property?
So you can actually do it for either one.
Okay.
So you can do it for your primary, and then you can also use that to leverage to purchase other properties, or you can do that in the purchase of a investment property or a second home.
Okay.
So you can use it in multiple ways. But the way this product works is it's tied to your bank account. It's got a bank account tied to it, to where as your deposits are coming in, it is immediately taking away from the principal balance of the loan itself. So as you're knocking down that principal balance, well, you're only paying interest on what that principal balance is. So if that principal balance is knocked down immediately, then you're paying less interest. So it's a different way to look at mortgages, and it actually, if you calculate the numbers on that one, it saves you a lot of money.
Okay.
But it requires more. It requires you to pay attention to it more.
Yeah, and so for something like that, you would actually be opening a new bank account that would have that home equity line of credit in there, and that new bank account actually has to become your primary bank account that your weekly, monthly deposits are going into in order to bring down that principal balance. Is that correct?
That's correct. So it's all going to be tied together that way. And yes, it would be an adjustment on how you kind of have things structured. But once you have it set up, it's a groundbreaking way as far as approaching the mortgage process.
I think we could probably do an entire episode all about that all-in-one.
Yes,
to really dig into how that works.
That is a complicated product.
Yes.
But it is an amazing product.
Okay.
Just because we've done mortgages the same way for so long, it's been fairly unchanging.
Okay.
So that's why I think that one's a very interesting one.
Great. So you've got the bank statement loan, you've got this all-in-one product that creates a home equity line of credit in order to make that purchase and pay down principal. And what other products do you have in addition to those?
And we've got a multitude. I mean, in all honesty, to try to list them out is that would take a while.
Yeah.
But because there's so many for all sorts of different type of scenarios. But there are ones for even folks with sub 580 credit scores.
Oh, wow.
Now, granted, even on those, everything's always, you've got to look at everything from a risk-based standpoint. So if for some reason on those ones where the credit is, below a 580, yes, there are ways to get it done, but in other aspects, things are gonna have to look pretty nice.
Okay.
Pretty clean.
So definitely showing that they've got stable income over a long period of time, and they're still a trustworthy borrower, even if they don't have that credit score up to where they need to be.
Exactly. Because the way I always say it is there's three main things that you're looking at, three main buckets. You've got your credit, you've got your debt to income ratio, and you've got your assets. So if you within those three, you've got to think if you're lacking in one, you've got to make up for it in the other two.
Okay.
So you've got to offset. So that's the best way to always kind of look at it. You want to at least have, two out of those three to be able to try to make it work.
Absolutely. So what about someone that, they can qualify for your traditional mortgage? They might be able to get a good interest rate because they've got the higher credit and they're looking at an FHA loan, but they really just don't have the money available to make that big down payment right at the beginning of the purchase. What types of programs do you have available for people that might need some assistance in that area?
So on those, we have a multitude of down payment assistance programs. So the down payment assistance programs are fantastic, and in those ones, the rate is dependent on how much assistance you get. So that's how those programs work. So in a lot of instances, those programs work really good for people that, let's say the credit's not the greatest, let's say it's, between 620 to, 660, in that range there. Typically what you may qualify for as far as a rate based off of your credit would actually be higher than what you would get if you were using the down payment assistance program. Okay. It's crazy how it works like that. But we've seen that many times. But those programs are fantastic. They offer assistance to the buyer to help cover the down payment, or even they can go towards the closing costs. They don't have to go to the down payment. So like, let's say if you're a VA buyer, you don't have a down payment. So instead we can use those funds to cover the closing costs instead.
Now, I know I heard you mention something where you offer an option where people can refinance as long as they stay within your company and not incur additional fees at the time of that refinance. right now when we're recording this, interest rates are pretty high, and it's causing a lot of people to be hesitant about purchasing unless they feel like they'll have an opportunity to refinance out of that higher interest rate in the near future. Can you tell us a little bit about that loan product where you can then do the refinance without incurring the additional fees associated with that?
Yeah, that's our rate rebound program. So yes, obviously rates have jumped up significantly since the beginning of this year. And now luckily we have seen them kind of level out a little bit, but we are anticipating that rates will come back down. But in the meantime, yes, we have the rate rebound program, which basically allows you to go ahead and purchase the house now, because right now is a good time to be able to try to find that dream house. You know, you're not fighting a million other buyers for the house now. Get the house that you want, and then within that 5-year period, yes, refinance when the rates come back down. We'll go ahead and cover all the lender fees. So we'll waive all the lender fees.
Okay.
And then we'll also throw $1,000 towards your title policy as well.
Okay.
So we'll try to help offset some of the title costs. And then obviously, since you're refinancing, it will wash on the escrows, so that'll keep those closing costs down as low as possible.
Okay. Well, it sounds like there's definitely a lot of options available. Even though we're dealing with these higher interest rates, it doesn't necessarily mean that home buying has to stop. There's still options available to people. And then I also like that you have options available to investors as well. I definitely appreciate you sharing all of this information with us. I think it's a real help to people that might be watching to know the options that are available to them. For anyone that might be watching right now that has some questions and might want to get a hold of you, Davy, how can people reach you?
You can always call me. My cell phone number is 361-523-1801. You can also email me. My email is dtyler, dtyler, @cmgfi.com.
Okay, great. Well, I appreciate it. Again, I'm Sophia Keeler. I'm with Keller Williams Coastal Bend. I'm a realtor here in the Corpus Christi and Coastal Bend area. If you need to reach me, my phone number is 361-756-1900, and I will include all of the information in the comments of this video as far as being able to contact Davy or myself. And remember,
she's a fantastic realtor, by the way.
Oh, thank you. And also remember to subscribe to my channel if you like watching these videos, so you can stay up to date whenever we put out a new one.
All right, sounds good.
Thank you.
Subscribe.